Making a 10x on your invested capital is actually pretty straightforward. The problem comes when we want to make that 10x within a very low time frame. That's when we have to get way more tactical. We have to time the market a little bit more. We maybe have to take some leverage. In this video, I'm going to show you a very simple strategy. You can relate this to Bitcoin, to altcoins, to S&P index, to NASDAQ index, to individual stocks, whatever. I'm just going to show you this very simple technique of actually identifying what is the trend rate of growth of the asset and how does it trade in cycles and how can I take advantage. You can use this over the short term if you want to trade, take a bit more risk, or over the longer term, if you can wait a little bit more, you can just work out how long is it going to take, how much do I need invested, etc. So I'll show you exactly this in this video. The first thing that I want to go over is how to chart the asset and then try to figure out its price cycles. So the first thing, go to TradingView. This is completely free if you don't have TradingView yet, so I'll link them below. Just sign up with an email address. I'm going to go to Bitcoin here and just show you because Bitcoin is extremely cyclical and it has a lot of growth. But you can use this on any asset that you want. Go to indicators. I'm using the Heikin-Ashi RSI oscillator. This is a price momentum indicator. So there are many out there and you can use them. They all show exactly the same thing. I want to find out, right? Because what we're seeing here is this asset essentially is just going up. Okay, so it's going up in value. So I've got an asset here that has a trend rate of growth valued in fiat currency. So it's going up over, let's say a 4-year period at a certain percent, right? But obviously, if I want to make returns over a shorter time period, I need to time those price cycles a little bit more effectively. That's what a momentum oscillator shows us. It shows us where the price is too expensive or too cheap in relation to its longer term trend. And that is the sweet spot for trading and how to make returns. So you need to pick an asset that actually has a trend rate of growth that is reliable, that you can invest in. That's the first thing, because there are many assets that go up a lot in very short periods of time. Altcoins, right? They go up 5, 10x, 15x within a few months or maybe a year or so. But if it doesn't have a trend rate of growth, you're taking extreme risks and having to get in and out. And you actually have to be correct over a very short period of time. Whereas if you have a asset with a trend rate, then you can actually get things wrong and you still have the ability to actually make money on that trade by waiting out the market and waiting for that trend rate of growth to pick up. So it depends where you want to sit on this. You can go super risky, you can go super non-risky, right? It's up to you. So this is a technique and you can just apply it to anything. What we need to find out, and this is very clear for Bitcoin, is that it has very individual and very distinct price cycles within its longer term trend. You can see this with momentum, right? So bearish momentum to the downside, bearish momentum to the downside, bearish momentum to the downside. These are the bear markets for Bitcoin price, right? Very difficult to trade there. But you can also see that this momentum indicator very clearly shows us where that bearish momentum essentially bottoms out and starts to go into bullish momentum again. And here, right, it actually had a second dip here, but this was the pandemic, so a little bit of an outlier. And then here we have again. So you can use a momentum indicator to essentially show you, there's actually, let's say 4 opportunities here, where the asset and its trend rate, the price is very low in relation to that. That's 4 opportunities to make the most returns out of the asset, right? Because it's growing at a trend rate and it has price cycles where the price is oversold, where you can see me here, and the price is also overbought. You can see these here, not quite overbought yet, but you can see it coming up, right? So that is how you can time markets more, by seeing the trend rate and then the price cycles within that. So do that for the NASDAQ index, do that for Tesla stock or anything else. You can just find the trend rate of the asset and then the price cycles that we can time if you want to time more. Firstly, though, I just want to go over the longer term way of actually thinking, well, how long will it take to make a 10x? I'll leave all of these resources below because you need to figure out what the trend rate of growth of the asset is. And then that's going to give you a time horizon. And then you can figure out, am I okay to wait? Do I want to be a bit more tactical? So firstly, what I've done here is gone to Grok and I've just said, I've got an asset here and it's going up 25% as a CAGR. CAGR is compound annual growth rate. You may have heard it as ARR, which is annual rate of return, right? Trend rate of growth is another one. Essentially, you can't learn that about an asset over 1 year. You have to take at least a 4-year period, right? So 4-year or 5-year compound annual growth rate. What is that over time? So then the S&P index is about 12%, the NASDAQ index is about 18%, Bitcoin right now is about 40%, right? And so you can just work it out. Now for 25% annual rate of return, that's a 10-year wait time. Now for the Nasdaq, for the S&P at 12%, you're probably looking at 20 years, right? So not great, right? Do you want to wait 20 years? Probably not. So where you like find yourself on that risk scale is up to you, right? For Bitcoin at a 40% CAGR, probably coming down a bit. You're probably looking at 6-8 years, something like that, depending on cycles and where exactly you buy there, right? So even less time. For assets that are faster than that, maybe even less time, but then what's the risk? I'll link this below as well. This shows you the CAGR of Bitcoin. You can work this out for Ethereum and some other assets as well. But again, it's not just about the CAGR, it's about getting an asset that you know has that longevity over a decade, right? You need that first, because if you get trades wrong, right? If you get a trade wrong in an asset and you lose 50%, you're like exponentially further away from making a 10x in your portfolio. So the main thing is getting that sweet spot of something that moves pretty volatile, but also you think, now this is solid, it's gonna be around in 10 years, because if I get the trade wrong now, I can wait and still make money. And that's important, because you can wait and then you can put more in at a lower price. Super important to be able to do that and have the confidence to do that. And a lot of altcoins, they go up, then they go down, you think, I don't want to touch it, which is not the best position to be in. So look up CAGR and work out what the CAGR of your asset is. You can go to Grok or anything and you work out how long that will take. 8 years in investing is not a long time to make a 10x on your money, just getting into the asset. So that's the first thing. Work out if you can wait and try to build a portfolio around that first, because you don't want to always be trading, trying to time the market. You want to be in with a portfolio that you can rely on of quality assets. And you're like, wait, 8 to 10 years to make a 10x? Sure, I'll do that. And then that gives you the strength. Once you have that, once you're 4 years in or 8 years in, and you've already made that 10x, then you can go ahead and trade short term and time the market more, because you don't have fear anymore. And that means you can buy these dips, which everyone else capitulates in. You can buy these because you're like, I've already made a 10x. I'm going to go in now. I know this asset is strong. Even if I'm off by 20, 30, 40% on my buy, I think it's going up again. I can wait. So you have the strength there first. So figure out what your mix is. Is it S&P? Is it NASDAQ? Is it Bitcoin? Is it something else? Figure out your mix. Figure out how long that will take. Have that in your mind, right? And then have that first. And then over time, as you start to make returns, you become a much better trader, because you don't have that fear, that FOMO and everything else that everyone has. So that's the first thing to do. Now to come into more tactical trading or trading over shorter periods of time, where we want to reduce the amount of time you make that 10x. And so again, it's actually the same thing. You need to find an asset with growth that you can invest in and that you think that will bounce from pullbacks within an uptrend. So this is the longer term version of doing that, which I think is the basis for any portfolio, right? Investing in strong assets and investing a lot when the price is relatively weak in relation to the trend. That's what short-term trading is as well. You have an uptrend here. It's just a bull market. It's an uptrend, and there are times where the price gets very overbought, or very, very high in relation to that trend, and then it does come down and pull back into that trend as well. So you need to just try and find areas where you can find these pullbacks in the trend. You can do this with dollar cost averaging. You just buy every week. You're going to be buying some high, some low, doesn't matter. The asset's going up at 40% a year, doesn't really matter, right? But for trading, how people will do this is they trade short term and they trade with leverage. That's the only way you actually reduce the time horizon where you make those returns, because you need to get more out of the market than you have invested. That leverage and that day trading also increases risk substantially, which is why I think beginners just shouldn't be doing this, right? You should just get that investment portfolio first. But I'll show you how this is done and then the risks as well. So the first thing is, why have I got these orange dots here? It's not because of the price. It's because of the momentum. By the way, I trade on Bybit, so I'll leave them below. Up to $30,000 as a deposit bonus if you're a new user. You can just click the link below and see that. Whatever you deposit, you'll get some sort of bonus. That's not available for everyone, so I'll leave some other links to exchanges you may need to trade on. Also, Apex is Bybit's decentralized exchange. If you're into crypto, you can just connect your wallet and trade from here. So you can trade futures and spot on here as well. Super good. There's a permanent fee discount by that link as well in the description. So we need to find out uptrend and the momentum of price. You can do that with oscillators like I showed you on TradingView, but those are super noisy, and I don't think they really show us much over short periods of time. What you can look at is on-chain data. So this is SOPR, short-term holder SOPR, and it shows us during uptrends, which is very clear, right? It's very clearly an uptrend here. So we have a bear market where SOPR is super negative and it's actually rejecting, right? You can see rejecting from this level. Then we switch, and this is when the Heikin Ashi chart showed that the momentum has switched. And we also see that SOPR is now essentially in the green and using this as a support level. So during an uptrend, we want to trade drawdowns. So these areas here just show you the drawdowns perfectly. 1, 2, 3, and then 4, 5, 6, and there's one here as well. So basically 7 opportunities to just buy drawdowns with an uptrend. Now, if you're trading in the spot market, like I said, it's no different to dollar cost averaging. You'll be buying pretty much around there anyway, just putting your investment in your portfolio and growing your portfolio, and that's great, right? And you're making great returns as long as the asset grows. For trading, to time that, right, and actually make returns, then you're going to be needing to increase the amount of money that you're trading with, because otherwise it's just the same as dollar cost averaging, and that means you need to take leverage. We can also see here with Glassnode, which I'll link below, the potential drawdown in bull markets, 20 to 30% in this bull market. Same here, 20 to 30% drawdowns, and then here was actually a bit more, a couple of 50% drawdowns, and that shows you the risk of trading. If you're buying an asset that you think has long-term growth, then you buy these drawdowns, you get drawn down some more, you don't care, you wait. You can see that during an uptrend, essentially you get a drawdown, then you go back up to an all-time high, right? That's what you're trying to trade. Drawdown within an uptrend, back to an all-time high. You're trying to time those. The reason why you don't buy peaks is because when you're trading with leverage, when you buy a top, that could easily draw down 30%. Now, when you're taking leverage, 30% turns into 50 or 60% drawdowns, and that's when you start getting liquidated on your trades. So that's where the risk comes in. So I'll show you how to do this. But essentially, if you're dollar cost averaging, you just buy these drawdowns. If they draw down more, you buy some more with your income, right? But what we need to find out is if we're trading with leverage, how that works. So what is leverage? So I'm using 2x leverage on Bybit here. You can see that 2x. Essentially what this means is you go in with $1,000. 2x leverage means you can trade with $2,000 in the market. The reason why the exchange lets you do that is because you have $1,000 of cash there to pay for the loss if it happens. So with 2x leverage, my $1,000 is now $2,000 in the market. If the price goes up 50%, that's actually 100% on my invested capital. I've got $1,000 of cash in there. I've got a $2,000 trade, goes up 50%, now worth $3,000, which is a $1,000 profit on my $1,000 invested. So 50% move turns into a 100% move. The unfortunate thing on the downside as well is that if you're in, a 50% move turns into a 100% move on your original capital. So if $2,000 invested goes down 50%, that's a $1,000 loss. On your invested capital, that's $1,000 lost, which is 100% of your original capital. So that's where leverage can make wins and losses much more. That's why you can't use that as a long-term strategy. It can only be used short-term with specific parameters. So I know that average drawdown, maybe 20 to 30%. So what I'll do is go to the chart here and say a 20% drawdown is somewhere where I want to go in and buy. And if I'm dollar cost averaging in my investment portfolio, then I'm just buying and putting it in there, getting a decent price. If you're trading, you have to be much more tactical. Say, okay, 20% drawdown, but it could go down 50%, which is this right here. So if I'm getting in at this level and I'm using 2x leverage, my trade can have this breathing room. So if I get in here with 2x leverage, the price can actually move from here all the way down to here before I get liquidated on my $1,000. And the exchange says, you haven't got any money to pay for the loss. And so we're selling out your trade and taking $1,000 back to pay for the loss, right? So that's how far the trade can move. Now, if you're using 3x leverage, that's a 30% or 33.3% move until you get stopped out of your trade, which means here to somewhere around here. So you have less breathing room to be wrong. If you're using even more leverage, 10x leverage means basically this move wipes out the original invested capital that you have, right? So the more leverage you take, you basically can't be wrong with 10x leverage, right? It's basically a bet at that point. And that's not really investing or trading, right? You're just betting, like basically the price will not go down at all from here. It's basically like, put your money in betting, right? You can't do that. So 2x leverage, I would say, is probably the max, 2.5 leverage, right? And that gives you some breathing room in the trade to say, during a bull market, the odds are that if I get in at a 20% drawdown, the odds of getting drawn down from there another 50% are fairly low. And so if I have maybe 7 or 8 opportunities to do that in a bull market, maybe 5 or 6 of them would be pretty good trades. And so what I can do is take leverage on that. And that means that on the upside, if we do get a 20, 30, 40% move, like if we went in here and I'll just go at this point right here. And then we came in for a 50% move. That's like 100% move to 2x leverage, right? That is how you increase the amount of returns that you make by trading within cycles. Then you put that back into your investment bags because the asset's still growing over time. Maybe you want to trade out of a cycle. Where do you trade out? We trade out the top of cycles, right? And that's pretty clear. You can see when the momentum changes, right? Not really here right now, but when the momentum changes, you don't want to be taking positions up here. You don't want to be long in any trading positions. If you're an investor, I think you just kind of wait a bit, right? Wait 4 years, wait 8 years. You'll make 10x on your money. If the price draws down like 50%, does it matter? It's going to go up again in the next one. So that trading can increase, returns in cycles, but for most people, that extra risk is maybe not worth it. That's up to you, but that's how it works. That's how you can try to essentially make a 10x with very low risk and waiting a long time, or taking higher risk and volatility, waiting a short time, and then day trading leverage is like the highest risk. The risk of loss is more. You definitely don't want to be losing anything, because if you lose money, then you're exponentially further away from actually making that 10x. But just choose your assets, what you want to trade, how you want to trade them. Everyone can take this strategy and implement it in whatever way that they want with the assets that they want. And I'll leave all of the information linked down below, and the deposit and trading bonuses down there as well. I'm James, it's MoneyZG. Cheers for watching, and I'll see you in the next one.